Hey everyone, happy Friday. Colby, the DGI Crab, reporting in here at the end of another exciting trading week. A little bit of an abbreviated week because we had a half day on Wednesday, July 3rd, and then market closed for July 4th. And not a ton of movement from last week to this week. Our buyable stocks, or our stocks that look like they're on sale, are going to be pretty similar. So we're about to dive in head first here, but before I get into anything else, I will mention I'm not a licensed professional advisor, and the opinions expressed in this video are just one crab's opinion. Now, I have uh, links to the four tiers, a video on each of the four tiers of stocks that we are going to go over today on the spreadsheet and see what looks undervalued, what might be a good buying opportunity. So, tier one, really the story of the week this week is kind of the same as it was last week. So, Nike had their epic crash a week ago today and fell from the low to mid 90s all the way down to the $74 range. I was watching Nike very closely today, and it was roller coasting back and forth from 75.90 to 75.05, and looks like it just kind of settled down here right in the middle of that today. So Nike may have hit the bottom. The price has just sort of maintained here all week in the mid 70s. It hasn't recovered. It hasn't gotten worse. So the longer it stays sort of flatlined here in the mid 70s, I think the better I feel about it making a recovery really sooner rather than later. We may not have seen the floor on this one just yet, but with Nike, I sit here and I look at it. It's yielding right now just shy of 2%. And as we went over last week, this stock usually yields about 1%, sometimes not even that much. So I am still feeling pretty good about this massive undervaluation here. And as we read the spreadsheet, just so you're aware, if we're in the green, we've got a 30% or higher undervaluation, which I'm basing off of the 4-year average yield compared to the current day yield. In the yellow, we're between 20 and 30, and in the red, we are 20% under 20% undervalued or worse. So Broadcom down here at the bottom. I'd love to start a position in Broadcom. I actually don't own any. It has not looked to be on sale in a very long while. It has been on an absolute tear over the last year, maybe even longer than that. If you're a Broadcom shareholder, I congratulate you. If I had some Broadcom shares, I'd definitely be doing the drip like I do with all of my dividend growth stocks. But I probably wouldn't be adding any more money to it. But man, I'd have been wrong at 1200, 1400, 1600. Here it is at 1703. It is just rocking and rolling, man. Nordson this week just crept into the green category here. I love Nordson, man. That is a dividend king with 59 consecutive years of increasing that dividend, usually by at least 10%, if not more. Not a household name, not a sexy company, but this is just one that has really done great work for people's portfolios for decades. If we jump over here to Seeking Alpha here real quick, let's just pull up Nordson just to get a little bit of perspective on this one. So Nordson's dividend yield about 1.2 right now. The 4-year average is not even a full percent at just 92 basis points there. And if we look at the history of the dividend yield dating back to 2014, we can see the average yield usually is less than 1%. There were a couple of years here back 2015, 2016 when the average yield was 1.15, 1.19. It's at 1.2 right now, yielding as high as it's yielded all year. And if we look at the max yield that it ever hit over the past 10 years, I mean, what do we have here? 1.71 at one point briefly in 2016, But you look at a lot of these years, it doesn't even get to that 1.2. And if it does, it's usually pretty briefly. So, Nordson definitely looks like a nice play right now at about 30% undervalued based on my calculations. Quick peek here at the dividend growth over the years. We can see it's very regularly double digit growth, 14%, 28, 16. Bit of a slow year, 2020, understandable with COVID at just 5%. But then 12, 14, 11, 10, 15, 21, 20, you can see how it's just been a massive, massive grower over the years. And it was a little bit slower through the 2010s, but it always increased. As I said, 56 years or 58 years, 50 plus years of increasing that dividend. Nordson, not a household name, but looks very viable in my estimation. And then United Health Group, just shy of that 30% undervaluation. It is almost in the green, yielding 1.72%. Gigantic company. Uh, Really, really strong player in the insurance space, as big as there is in that space. Very safe play overall. Lowe's, I mentioned last week when Lowe's ticks up above a 2% yield, that starts to get my attention, and I start thinking about adding on to it. Their last dividend increase, just 4.76%. Disappointing as all hell. Usually Lowe's is easily a double digit 10, 12, 14% dividend increase company. They played it a little conservative this last time, but with a 35% payout ratio, Lowe's is in no danger of ending their streak of 60 consecutive years increasing the dividend. And then Kroger recovered in price a little bit, so to speak, from last week, got a little bit better price. It was in the number 2 spot last week after increasing their dividend. It slipped down a little bit. Still doesn't look like a terrible buy here at 51.84. And man, I'm just waiting for automatic data processing and Visa just drop in price a little bit more so I can add some to those positions. Right now, I think they're still better as a hold, but automatic data processing just knocking on the door, knocking on the door. So that's it for our 18 to 31-year-old investors in the tier 1. Let's move over to the tier 2, where Hershey still is taking that top spot at 51% undervalued. The current yield is just a shade below 3%. I absolutely love it right there. I added to Nike this week. I certainly added to Hershey. Now I'm in this 31 to 41 tier range, so this has been where my focus has been. Last week I didn't add to Starbucks. This week I did. I can't ignore it here in the mid 70s, yielding 3% or better. Definitely feels like a strong move. Target still kind of meandering along a little bit, flatlining, kind of like Lowe's. They usually have a stronger dividend increase than this, but their last one at 5.8% was just kind of meh. And I think just consumer spending habits are a bit conservative right now, and it's just having an impact on any big box store, Target being one of the big ones. McCormick, check your spice rack, right? I mean, they just you've got your salt, your pepper, all kinds of different spices. Very, very underrated company. I don't see very many financial channels on YouTube even bring this one up. I don't know why. Super under the radar pick, 2.37%. 4-year average is 173. I like McCormick here. Maybe not as much as Hershey, but I certainly like it here. And then American States Water, one of the longest dividend increase in streaks there is at 68 years. Just has been a tough year for American States Water. But down here in the low 70s, I still really like it. If it dropped down below 70, I'd be doing cartwheels on my way to my Robinhood app to purchase it. But let's see. So I did add to Hershey. I added to Starbucks this week. I did not add to Target. I added a little bit to McCormick. I did add to American States Water. And let's see, did I get any of these in the... Oh, yes, and I added to McDonald's at just a shade below 250. McDonald's, one of my top 10 favorite stocks. I've done a separate video on my top 10 favorite stocks of all time. McDonald's gets into this yellow range. I buy it. I don't even wait for it to get into the green at 30% undervaluation. McDonald's is in my top 10. I think it's in my top 5, to be honest with you. It's my favorite REIT. Look that up. Look that up. My favorite REIT. Watch the founder. Let's see here. Atmos is 12% under. Still just waiting on that. Home Depot, close, 17 and a half. Still not quite low enough for me to want to add any more into that one. Tier 3, age 42 to 53-year-old investors. Hormel still firmly ensconced here at the top. Brutal year for Hormel. I want to take just a quick look at this one since we didn't dive into Hormel last week and just see what it's doing. You can see it's yielding 3.7%. 4-year average, 2.41. If we look at the dividend yield history, take a look at the average yield dating back to 2014, we see a lot of years in the ones, mid to high ones. Last couple of years in the low twos. 2023, it sort of started to slide a little bit. That max yield finally got up above 3% in 2023 after never reaching even 3% from 2014 to 2022. Even in 2020, the COVID year, the COVID crash, max yield 2.15%. Today, yielding 3.7%. So let's take a quick double check on that payout ratio because that has been creeping up just a little bit. Payout ratio sitting at 69.25. Let's see, I've got them here at 67. I'll go ahead and update that. Why not? A couple percentage points. That's creeping a little high for a consumer staple. But this has just been a tough year for Hormel, and it might be a great opportunity to buy them at a discount. If it drops below 30, I may bend my own rules and jump up a tier and grab a little bit of it. But really tough year for Hormel. But again, might be a time to buy them on sale. Archer Daniels Midland takes that number 2 position. Fantastic stock. Still recovering from the drama of firing a CFO earlier this year. Medtronic and American Tower right next to each other, darn near tied for 3rd place in this tier. I don't think you could go wrong with either one of these companies. I think both have a safe dividend payout ratio. They've been a little more conservative on dividend increases lately than they have over the last decade. But very, very solid companies. And then another 2 stocks from my top 10 favorites, Johnson & Johnson and Pepsi. Here in the yellow, J&J at 25% undervalued, Pepsi at 20%. Love them both. And if you are in this age tier and you wanted to add to these 2 over Hormel or Archer Daniels Midland or these here in the green, I wouldn't blame you. Just safe, steady Eddie stocks, Johnson & Johnson and Pepsi. I'm not the least bit concerned about them. Could be a good time to build up a position there. And then finally, Tier 4 are 54 and older investors. Not a lot of change from last week. Realty Income looks like the only one in this smaller group of just 10 stocks that looks like a decent value. Now, I love Realty Income yielding at 6%. Absolutely. If you want to build up a position in everybody's favorite monthly dividend paying REIT, hard to go wrong with Realty Income. They just recently did their quarterly dividend increase. This one was just 0.19%. Not a big deal. They do 4 dividend increases a year, and usually those total up to about a 3-ish% total increase on the year. Tough year for REITs. There are REITs that are not as strong as Realty Income that are just not as well valued as this one. I think they're being kind of punished for the share dilution from their acquisition of Spirit, I think was the name of that company. Anyway, definitely liking Realty Income. Not a huge fan of the value I'm getting at any of the other stocks here. So if you wanted to focus more on a high-yielding ETF like an SPYD, a DHS, maybe a high-yielding bond ETF or something along those lines just for more diversification instead of single stocks, Still not a bad idea to do that this week, but I love Realty Income at these levels. So, all right, everybody, that is the week in review. I hope you will all be ready to make a plan this weekend and attack investing Monday morning with some of these stocks in mind. Until next time, I'm Colby, the DGI Crab. See you next